Hi everyone, if you can see and hear me loud and clear, can you please type in the chat, type yes in the chat and let me know, okay? If you can see and hear me loud and clear, huh? Okay, thank you Wayne, thank you Samuel, Jean, Evan, Rachel. I think most of you can see and hear me loud and clear. So welcome and thank you for spending your Sunday afternoon together with me on this special premium training for Alpha members. Okay, so Alpha Quadrant members. So what happened today is that I want to go through how to screen for ideas. Okay, and the ideas that I'm going to teach you how to screen, right? Is based on the methods that I use personally myself. Okay, we may have shared with you a lot of methods on online. Okay, on the Alpha Quadrant website, but then there's some methods that I only use it for myself only, right? And I use it frequently. Okay, I don't, even though we teach you a lot of ways to screen, right? At the end of the day, right, it's not about screening with different ways, right? It's about finding the ways that you screen for ideas that is suitable for your own personal needs. Okay, so without further ado, I think we can move on with the slides. Okay, give me a minute. Okay, yeah. Okay, so let's move on. Okay, so I'm just going to teach you how to screen for investment ideas. So basically, these are the 5 different methods that I use personally myself. Okay, and I'm going to go through with the stock screener first, which is the one that is taught in Alpha Quadrant, and I'm going to go it through live as a refresh for you. Okay, and of course, I'm going to do look through the companies, and we're going to do it live. Then after that, we're going to go through same like how you go for the Alpha Quadrant on live webinar. I'm going to do some games with you. Okay, so then you're going to choose which companies that you want to choose. Then I'll just talk about it from there. Okay, so then I'll also be going through, like, for instance, example, sometimes I do look at companies in the 52 weeks low. I can also find ideas from super investors, insider trading, and also share buyback. So these are some of the sources that I use it personally myself. Okay, but what sources I'm going to share with you is basically I try to share with you free sources that you does not require you to pay to get all those information. Okay, but of course there's some cases, like for instance share buyback, right? You have to do a paid sources. Okay, I can share with you the paid sources that I found, but I'm using another type. But the sources that I'm using is much more expensive for retail investors. Okay, Jeff asked, will this webinar be replayed? I check with, I'm checking with my marketing team. I think most probably yes. Okay, most of the time we do send replay, so don't worry about that. Okay, I think high probability that we do have a replay for this webinar. Okay, so I'll be going through all this method, but your job as an investor is to not, like for instance, do all the method. Okay, so when you just start out as investing, right, you need to choose either one of these 5, or maybe you got other ways to screen. Okay, and you need to train yourself or create a habit, right, that one of the screen, right, that you screen for ideas, right, becomes like a daily thing, like becomes like a habit to you already. So when it becomes like a habit to you, right, you becomes very automatic for you. Okay, then once you are very familiarized with that one type of screen, right, then you can move on to the next screen. Okay, please do not, like, when you start, like, oh, I want to do stock screener, 52 weeks low, super investor, insider trading, share buyback. If you were to do that, I can tell you, right, you will burn out, and eventually you will feel that investing is very, very hard, and you do not want to screen for ideas anymore. Okay, please do not do that. Try your best, right, to just focus on one first, build the competency, then move on to the next method to screen. Okay, do you agree with me? If you agree with me, just type yes in the chat box and let me know. Okay. Okay, so I'm going to start off using the stock screener. Okay, and the one that I taught you during the Alpha Quadrant online course, and also the Alpha Quadrant live webinar. Okay, so basically we're just going to use FinViz. Okay, and what we're going to screen is we're going to screen companies that have revenue growth of at least 5%. Okay, at the end of the day, why I say that, why we want to screen revenue growth is because how much can you cut or how much can you save in your salary, right? That can keep continuously grow your profits. Eventually, there's a limit when it comes to saving. Okay, so at the end of the day, it's all about increasing your income, increasing the revenue, so that if your saving rate maintain, your profits also your profits also increase. Okay, and after that, we want to screen for companies with at least 20% gross margin, right? The 80-20 rules, and also another thing that I didn't do inside the Alpha Quadrant Online is the screening for operating profit positive. Okay, that means we want to look for profitable companies. Okay, so let's move on to the Finviz. Okay, so before I move on, let me go through this example first. Okay, so when you screen out the Finviz, YK asks, can we use share investors to get screening data? You can do it. Okay, I have not used share investor for a long time, so I'm not so sure how are they like right now. Okay, but do take note that sometimes share investors data can be wrong. Okay, so after when you do the screen of that 3 criteria that I told you, right, the next moment is all those companies that came out. You want to go through all these criteria, like your asset intensity, your ROIC, your cash versus debt, and your debt to cash flow ratio. Okay, so asset intensity is to actually screen for asset-like companies. Okay, but this is best used together with the ROIC or the free cash flow equity. Okay, but you use it alone, right? Sometimes companies can have 60% or just slightly above 60 or 70, right? But then they still can generate good ROIC because their inventory turnover is very high, even though they have very high inventory. So there's still some flaw in this asset intensity. So that's why you have to pair it up with the free cash flow equity and also ROIC. So next is you want to look at the ROIC. So the ROIC formula I already taught you inside the Alpha Quadrant Online. So I'm not going to teach you the formula over here. So if you want, you just go to the online and refresh on the formula. Okay, so the ROIC, right, we want to have at least 20% and above. Okay, next is we want to look at companies whether they are okay, sorry, I thought I didn't show the slides. Okay, so the next is we want to see the companies, right, whether they are in net cash position. Okay, so if they are in net cash, right, the debt to cash flow ratio, right, no need to do it. Okay, but if they are in net debt, right, then you have to look at the debt to cash flow ratio, which I put over there. I forgot to put a C. So look at debt to cash flow ratio. So which is must be less than 5 times. Okay, so that is basically the criteria that we're going to be looking at. Okay, are you clear on this criteria? If you are clear, I want you to type yes in the chat box so I know that all of you are clear. Then we can move on, right, to do the live screening. Okay, are you guys clear? Okay, cool. Okay, cool. Okay, so thank you, Wendy. Okay, thank you, Rachel. I think most of you are clear. Kinwei, Siu Yan, Victor, Eric. Okay, SY. Okay, yeah. So let's move on, right? So I'm just going to switch to the screener part. Okay, I'm going to turn my face off, so I don't want to block all some of the numbers and all this. Okay, so if you look at the Finviz, right, I think it's one of the better tools when it comes to screening. It does have data also, right? So but the screening they give it for free. So if you want to pay the Finviz, you still can pay it. Okay, because I think because the unpaid one you cannot export. So if you pay, you can export the figure. Okay, so you can consider if you want. If you want to save money, then you don't pay first, but you just use yours. Okay, so what I do initially when I started out investing, right, is I didn't subscribe to a lot of paid service. I use a lot of free service. Then until I get very used to it, then I think that okay, I think I can do it much faster. Then I already created the habit to even do screening. Then I start to do the paid service to do. Okay, because a lot of time I realize a lot of people is that they do pay the service but they don't use it. Okay, so please do not do that. First, hands-on first, try the free service. Then until you know that you really have the habit to do it, then you go and pay it. Then you will save money. You don't waste unnecessary money on that. Okay. So if you go to the Finviz, you can see there's this screener over here. Just click on the screener. Okay, so you will come to this page over here, and usually I'll click to fundamentals. Okay, sales more than 5%, gross margin more than 20%, and operating margin positive. Okay, so these are all the the figures over here. Okay, so you can see from here. Then from there, right, you want to go in and do a quick screening. Okay, so in the online course, actually, I did a quick screening on the what's the company using the ROIC.ai. Okay, so maybe okay, let's from here. Which company do you want to look at? I just do a quick one. Which company you want to look at? From this list, from the first list. Okay, just type the company and let me know. Okay, then I'll just go through that company right now. Do the quick screen on the asset intensity, the ROIC, the cash versus debt, and the debt to cash flow. Okay, I think to Adobe. Okay, so I can see a lot of Adobe. So okay, let's go through Adobe. Okay, so very simple. Okay, so when you go through this, right, you just go to the ROIC.ai. Okay, which is free also. Okay, for certain data. Okay, Adobe. Okay, so usually you have to choose the one with the US composite. US, where's it? What's the original? I think should be this. Yeah. Okay, so you'll come to this page, right? Okay, so first you want to screen for asset intensity. Okay, so you go to financials, right? Very simple. Okay, so like all the latest data they'll block you, but the full year one they'll give you for free. Okay. So for instance, the first one we're going to do the asset intensity. So if you have gone through the alpha quadrant online, right, you know the asset intensity ratio is basically your fixed asset, which is your inventory, and your property, plant, equipment divided by the total asset. So let's look at it. Okay, press the balance sheet. Okay, so your inventory. Okay, so basically this company got no inventory, so 0. Okay, so it's your property, plant, equipment, which is the net off figure, which is around property, plant, equipment minus accumulation. Wow, this ROIC.ai is so messy. Okay, I think it should be this figure. Yeah, this one. Okay, let me double check on it, the figure. Okay, so now I want you guys to take 2315. Okay, take 2315 divided by the total asset, which is over here. Okay, so you take 2315 divided by this total asset. Okay, so what's the percentage? Type in the chat box and let me know. Okay, so I just got back from my marketing team. There will be a recording, will be a replay sent to you, so don't worry about that, okay? Okay, so when they say 8%, do you guys get 8%? Let me check. 2315 divided by 2616. Yeah, about 8.5%. Yeah, so our criteria is to be less than 60%. So basically this company passed lah. So the next one is really to calculate ROIC. So if you've gone through the online course, right, the ROIC formula require a lot of steps, right? So to make it simplified, right, actually the ROIC, the ROIC.ai summary, right, there's also return on invested capital over here. Okay, but I do not know how they calculate it. Okay, because there's actually a lot of ways to calculate return on invested capital. The way that I taught you, right, calculating return on invested capital is based on Joe Greenberg style. Okay, which I think makes the most sense. Okay, but in this case, right, I don't know how they actually calculate the ROIC.ai, the ROIC, the formula. Okay, but then we just take a rough gauge. Okay, so we see like, okay, example, if you are too lazy to calculate one by one, then you just use this as a rough gauge. So you can see that the latest 2022, right, is about above 20%. Okay, so generally this company pass. Okay, just take it as pass. Okay, so that is a quick and dirty screen for you. Okay, if you do not want to go through one by one calculating the formula, which is there's a lot of formula. Okay, so if you just calculate, so it's about 25.24. Okay, so pass. Next is we want to look at the cash versus debt. Okay, go back to financials. Okay, so you look at the cash, the total cash. Okay, no, this one. Okay, this is the total figure. Sorry, this one is equals to this one plus this one. Okay, so it's 6 billion. Okay, so the cash is about 6 billion. The debt is about 587. 587, give me a minute. I just type 587 plus 4046. Any more debt? Yeah, no more debt already. Yeah, there's no other debt. Okay, so just the cash is about 6096, right? So 6.1 billion. The debt is about 4.6 billion. So is it net cash or net debt? Type in the chat box and let me know. Is it net cash or net debt? Okay, type in the chat box and let me know. Okay, so you know net cash. Okay, so in this case, right, this company, right, is in net cash position. So no need to even bother to calculate the debt to cash flow, because this company won't go into financial trouble. Okay, so it's okay. Okay, so pass. Okay, but let's say example, I still want to calculate the debt to cash flow. So very simple. The debt is about 4.6 billion. You just go to the cash flow. Okay, where's the cash flow statement? Right at the bottom. Yeah, cash flow. Where's the operating cash flow activity? Okay, 7 billion. Okay, so you take the debt, right, which is 4.6 billion divided by 7.8 billion. Okay, so what is the debt to cash flow ratio for this company? Type in the chat box and let me know. What is the debt to cash flow ratio of this company? Xin Wen said less than 1. Yeah, I understand it's less than 1, but get the exact figure. Come on. Investing, I know it's roughly there, but must at least still get sort of like roughly the figure, not less than 1. Okay, but yeah, it's less than 1, yeah. Okay, how about the rest? Do you get the numbers? 4.6 divided by 7.8. Okay, so it's about, yeah, so you can round it up to 5.59. So what this means? What does 0.59 mean? Because 0.59 means about roughly around like maybe less than a year, right? They can pay back the debt already. So that means this company, right, is not heavily leveraged. Okay, so I put a benchmark at 5. That means, right, the cash flow must cover the debt. The cash flow must able to cover 5 years of debt. Okay, if anything more, I feel that the company is heavily geared. Okay, so I got a concern about the company. So I will want to invest. Okay, because if interest rates start to turn against the company, if they have a lot of floating, right, then that's going to be a lot of trouble for the company. Okay, are you clear on that? If you are clear, I want you to type yes in the chat box and let me know. Are you clear? Okay, so that's basically the method that I taught you. Okay, so right now, let's go back to the slides. Okay, we're going to play some games right now. Give me a minute. Okay, so right now I got a few companies over here. Okay, I just put my face to the maybe the bottom or something. Okay, right bottom. Okay, yeah. So I got about A, B, C, D, E. Okay, so these are the ratios that are shown here. Okay, so I want you guys, you can choose more than one company between A, B, C, D, E. Right, based on the quick look, right, which one will you choose? Okay, just type in the chat box. Okay, type in the chat box and let me know. Okay, A, E, D. Okay, let me see. Quick look. Yeah. Okay. So E, A, okay. E, A, D, E. Surprisingly, there's a lot of A, D, E. Is there B? There's some B. Okay, you can choose more than one, not only one company only. Okay, so I see a lot of you actually choose A. Okay, so let's go through the companies. Okay, so all these are actually real companies. So a lot of you actually choose A. All right, so I can see A is the majority. Surprisingly I saw a lot of E. Okay, and also D I also saw. Okay, no one choose C. I don't see anybody choose C. Did somebody choose C? Okay, so it's A, D, D is okay. Somebody choose C. Okay, so let's look at the companies. Okay, so all these are real companies, right? So those that choose A is actually Apple. Okay, so you can see Apple got very, very beautiful record. So if you look at Apple over here, first it's very asset light. Second is that they generate very high ROIC, even though they are net debt, right? But their debt can be paid within a year. Okay, so pass. Okay, company B, yes, is also asset light. Wingstop, right? The food one is a franchise model. They generate very good ROIC. Okay, the only concern that I have for this company is that the debt to cash flow is actually 9.37 times. So that is a very, very big concern over this company. Okay, so I may not, or I will not look at this company. Okay, because of the debt. Okay, but if the debt levels tends to become less, right, maybe I will consider looking at this company. Okay, remember the only way, one of the surest way, right, to bankrupt your company, right, is highly leveraged. Okay, and as long as you avoid companies that are highly leveraged, right, you already remove one factor that can surely kill your company already. Okay, so do take note about that. Okay, so I surprised some of you can choose C, because C already shows you that it's asset heavy. Yes, it still generates ROIC, net debt, and all this. Okay, but of course I didn't show you the business model. So I think this company, right, Mosaic, if I'm not wrong, it's an oil and gas company. Let me check. Let me check what company is it. Yeah. So all these companies I took out from just now the screen on. Then I just randomly took out some of them and I just test you guys. What is the company? Vital Nutrients. Oh, it's sort of like an agricultural business. If I know. Yeah. Let me see. Oh, it's a mining business. Okay, it's a mining business. Okay, mining fertilizer business or something like that. Okay, so I will not look at this company. First, it's asset heavy. Okay, but does not mean, like I told you, the asset intensity there's a flaw. You still have to pair it up with ROIC. Okay, so you look at this company, right? The asset is less than 60%. So you pass our criteria. These are Ole bargain store. But the ROIC generated is only 13.9%. Even though it's net cash zero, right? I may not want to see it. Okay, I mean, you still can look at this company. It's just that you won't generate fantastic returns, right? Because the ROIC is so low. So the chances of this company generating probably is about 10 to 12% over a long period of time. It's still decent, okay? Which this company eventually really generates 10 to 12%, I think, over a long period of time, okay? Because they generally still require the asset. Okay, so if you understand about Ole bargain store, if I'm not wrong, it's sort of like they. Okay, let me search over here. Okay, let me search and show it to you. Give me a minute. Okay, let's switch to the laptop first. Okay, so if you go to Wikipedia, you can see what they basically is. So they like a discount closeout up retailers, right? So it's still a normal retailers that sell bargain stuff and all this. right? So basically people like household apparel, all this, or anything, they sell anything under the sun and they tell you that it's cheap, okay? So it's generally still a very competitive business. But then if this company do very well, okay, as long as you sell cheap, right, still got people who go and visit you and all this. Still not so bad, okay? So next is TJX, okay, which is about Vishu asks, any reason other debts and debt liabilities are not considered the calculation? Okay, so like I mentioned before, right, debt, right, the only people that can bankrupt you, right, at the end of the day, right, is the banks. Because when you borrow money from them, they'll sue you all the way until they take every of your assets, okay? But for, let's say, example, suppliers, like payables, or this, at the end of the day, right, if you don't pay your payables to your supplier, and you tell the supplier, hey, I go bankrupt, they just write off the thing, okay? But banks, they don't write it off. They will go and seize your assets and seize everything of your company, and you'll take it everything, okay? So it's much a dangerous debt as compared to a normal like supplier debt, okay? I hope I answered your question, Vishu. Okay, so let's look at TJX. Okay, so if you look at TJX, right, it's a very interesting. How many of you actually choose E? Sorry, the last one. Can you type me and let me know? And can you share with me why do you choose E when the asset intensity is like above 60%? Okay, can you share your thoughts with me? Anybody can share? What do you choose E? Because I'm quite curious, because you are being taught to look at asset intensity less than 60%, but you guys still choose TJX. What is the thing that attracts to you? Okay, so Krishna say net cash and debt and low debt to cash flow. Yeah. ROIC is decent. Yeah. How about the rest? Anyone else? Okay, yeah. So so that's why I told you the debt to the asset intensity do have is flawed also. Okay, so if you look at TJX, right? TJX is basically, how many of you actually know TJX? Can you type in the chat box? Okay, so let's look at a bit of what is TJX is. So if you look at TJX, it's basically like a departmental store, but it's a very, like how to say, discounted departmental store. That means you can find very, very cheap clothes over there. Okay. So if when I guess wrongly, I can't remember what is it, right? They basically got their clothes from somewhere and they sell it in their TJX store at a very cheap price. And if you want to find cheap clothes, right, you have to go inside TJX and hunt one. They created like a game that you must go inside and hunt, look out for the cheap clothes. They won't put the cheap clothes outright in front of your face or something like that. You have to go and hunt for it. Okay, sort of like that. Okay, so everybody knows TJX is a very, very cheap clothes player, and of course, clothes is much more recurring as compared to your Olay store, which they sell a lot of other stuff. Okay, so the reason why, if you were to look back at TJX, right, I will look at TJX rather than I will look at Olay store is because you see, first the ROIC. Okay, even though this one the asset intensity is lower, but the ROIC is very low. Okay, so I may not want to look at it, even though they are net cash. Okay, but if I'm okay with like a 10-12%, maybe I'll look at this company. But if I'm not okay, right, I would rather look at TJX, even though TJX, right, was 73% net asset intensity. So if you were to look at the free cash flow and equity and the ROIC, right, they do pass our criteria. So that's why I told you, right, this one standalone, right, is not really good to look at. But if you mix it with like ROIC and free cash flow equity is better. And of course, they are also in net cash and their debt can be covered in less than a year. Okay. So if you look at TJX, if you have invested TJX for 34 years, your returns is 15.9% compound annual growth rate ex dividends. That means I haven't include dividends. If I include dividends, your return should be about 17-18% for 34 years. I think not bad for a company that have this asset intensity. Okay, asset intensity is one thing. Second is, right, if you know asset intensity, right, the majority of the assets, right, is actually we talk about asset intensity, right, is the fixed asset, which is the inventory and the property, plant, equipment. So for TJX, right, a lot of their assets is actually the inventory. But if the inventory is able to turn very fast, right, even though they got high intensity, right, it's still okay one. That's why you must look at the ROIC and free cash flow on equity. Okay, so that's why I didn't want to explain so much during the Alpha Quadrant online or the live webinar. Is because, right, I don't want to confuse you guys. I want you to learn one method first. Then now we do a special webinar to explain to you that there's actually some ways to bend the rules. Like for instance, not only purely asset intensity. You have to look at asset intensity. You have to compare it with free cash flow equity and compare it with ROIC. Okay. This company, right, if you go and notice, right, Ole Bargain Store, even though why they are generating so low ROIC is because their turnover, right, their cash conversion cycles are 100 over days. So that means they take 100 over days, about 3 months plus, right, to convert their inventory to cash. Whereas if you look at TJX, right, they only took about 1 month or less only. So even though they got a lot of inventory, right, but they can turn it very fast. That's why they can generate better returns. Okay, so at the end of the day, is how fast they turn the inventory. Okay. Qing Yao asks, in this case for companies like TJX, should we look at the inventory turnover if available? Yes, you can look at it. I'll say that you don't need to look at the inventory turnover, but you can look at the cash conversion cycle. That is a better figure. Okay, I hope I answered your question. Okay, so how many of you actually feels that you learned something that I just explained to you on this another perspective of looking? Okay, if you have learned something, just type yes in the chat box and let me know. Okay, but drink some water first. You guys just reply in the chat. Yeah. So I want to progressively teach you guys. That's why there's this special webinar. Okay, because if I chunk everything inside, I can tell you cannot take the information. Okay, so that's why there's a webinar to help you. Okay, I hope you guys like this special premium webinar that we created for you. Okay, so let's move on. Okay, so next is you can, what I say, do copy trade. Okay, you look at super investors. Okay, so how do you look at super investors? And that's also some place that I find my ideas also. Okay, so for instance, this place called DataRoma. Okay, so when you look at all these super investors, right, you need to look at, how to say, example, like the percentage of their portfolio. Okay, so for instance, let's say they say that, oh, Warren Buffett buy into this company, very good, but then the company is just 1% of the portfolio. Then I got a concern. Okay, so you must make sure that the percentage, you go inside and look at their portfolio, right, you must see what's the percentage allocation. But also do take note that because the portfolio, right, they shift with the valuation, so the percentage allocation also may not be true. Okay, so the ideal way is to see, right, when they added new position inside, then you can go and take a look at the company. Okay, this is another way. Okay, and another way is that when you look at the investor, right, you need to understand that investor, that particular investor, because if you go to DataRoma, right, there is many super investors inside, but not every super investor fits your criteria. You need to find one, right, that fits your criteria, and you need to know their style. Okay, so for instance, example, you go and look at example, let's say Seth Kalman. All right, very good track record. He compounded the position for, I think, 40 years at 20%. Okay, but this guy, he invests in companies like value, right? He look at the company with value. Okay, not about quality, but about value. But then he invests like maybe 5% stake on each of the company only. Okay, so you know that actually there's no weightage to all these companies. Your job is to really look at the company that they invest in. So for instance, next you got another investor that is very concentrated on. Then you see that, hey, this concentrated investor got a track record, right, of performing very well. Then you look at the concentrated investor, then you see the concentrated portfolio, right? What are those companies, right? Especially the one that bigger position or something, right? Is it still value, and why did he buy that, and when did he buy that? Then you from there you can roughly see. Okay, Because in the US, right, if you want to invest, right, if all these fund manager when they invest, they have to report one. So that's why this data Roma they track every time they come out the report. Okay. But of course, I one thing I need to say is you need to be careful of like investors, right? Who suddenly, wow, the portfolio change everything, then keep changing. Like they buy it, then they suddenly change. Then they buy it, they suddenly change. There's some super investors who are like that. So for instance, like Michael Burry, right? The guy who do the big shot, right? So he caught the 0809 financial crisis. He caught it right. But subsequent years, he caught for the he caught for the market crash all wrong. Okay, so be very careful. And sometimes he can like sell off all his position, then go short the market. Then he suddenly can suddenly buy a position. So you have to be very careful of such investors. Another one I look at is actually Monchy Prabhai. So Monchy Prabhai also used to be, I feel he got very good record, but in recent years, he's sort of like changing his position very, very fast. So when a investor keep changing the position very fast, I feel it's like, I know you have to be fluid in the market, okay, but also you also need to see how much research they have done. So the best investor is those that they don't change very fast, but every time they make the call right, they are right most of the time. These are the investors that you need to go and track, and you need to go and look at it, okay? Okay, so then you will get to understand, okay, which investor suits you, then you can get the ideas. Are you clear on that? If you're clear, just type yes in the chat box and let me know. Okay, so let's move on to look at the data Roma. Give me a minute. Just start data Roma. Okay, I'll switch to my laptop. Okay, so let's look at data Roma. So you look at data Roma here, you just click on top here, super investor. Okay, so you can see all the different super investors over here. Then you can see the ideas. Okay, so you also can see what's the thing? Activity, yeah. Like who is buying, the top buying and selling. So from there you can see the each of the super investor top buying and selling also. Okay, then you can see there's one place where let me see. Yeah, but so if example let's say you click inside, you can see the super investors position. What is the percentage of the portfolio on their what? Okay. So the best one is to see the recent buy lah. So you can see like, okay, this Bill Gates and Melinda, they went to buy Berkshire Hathaway. So these are some ideas you can look at. Lee asks, can I know these are considered individual or fund management? They are individual and fund management. Okay, so you can see the activities. Okay, I usually look at the buy lah. I won't look at the sell lah, because I'm looking for ideas. Why do I want to look at sell? There's a lot of reason that people sell. Later I'll show you. Okay. So let's look at super investor. Okay, so some of the super investors that I like, let's example, Warren Buffett. I think Warren Buffett is one of the top super investors. Charlie Munger also. Right, they hold very concentrated portfolio, and most of the time they call it right. So every time when I see those, I will go and see, okay, what are the position that they have? Is it still undervalued at the moment? Okay, so like for instance, let's say I go to Warren Buffett. Over here. Okay, let's create another tab, easier. Okay, so you see Warren Buffett, the activity, all this. Okay, so you can see Warren Buffett has been buying into Capital One Financial, Occidental Petroleum. Then I'll go and find out, why is he buying it? Okay, he have a very strong track record of buying good company. So I'll consider that. Okay, another one I think you can look at is this guy called Terry Smith. Okay, Fund Smith. So he focused a lot on companies that have generated very good return on invested capital. Right, the ratio I tell you. So I want to see what kind of companies he's buying. He's buying Procter & Gamble, Marriott, MasterCard, IDEX, Water Corp, Otis. I want to go and find out why is he buying all these companies. Okay. Agnes asks, may I check again who is the one that who achieved 20% return over 40 years with 5% allocation for each company? Seth Kamen over here. Okay, super investor again. Seth Kamen, SETH. This one, Bosco Fund. Okay, but in recent years, he not only is equity, he already diversified to a lot of other stuff. Okay, so he buy based on value. He don't look at he believe in value. Like so, the company cheap enough, he'll buy. But then every time when the company hit the value already, he will sell already. Okay, he don't hold his position. Okay, so yeah, so there's a lot of activity when it comes to this. Okay. Another one of my top favorite is this guy. It's relatively unknown, but I think he's quite good. Is this guy called Norbert Low, Punch Card Management. Yeah. So he's a very concentrated investor. So I got my ideas from him sometimes. Like for instance, like Smith and Wesson that he bought. Yeah. I was like saw that he bought Smith and Wesson. So I go and take a look at Smith and Wesson and all this. I think from there I say, oh yeah, and I think it makes sense for when he look at the company. Okay. So that's how I choose. Okay. Okay, Rachel asks, how do we choose the super investors that suit our investment style? Okay, so this is very subjective. Okay, you need to know what kind of investor are you. Okay, are you looking for value or are you looking for growth, right? And are you a concentrated or are you a diversified one? Okay, so if you are a diversified investor, most of the time when the company hit a certain value, you have to sell. Concentrated also, you hit whichever way, right? But you know that those diversified ones, they buy because of value. They don't care less about the company. But if a concentrated portfolio investor, right, they tend to be more focused on the quality of the company when they buy into it. Okay, so you need to look at your style. Okay, basically, like for instance, example, Carl Icahn, I don't really like him, so I don't follow his pick. Right, so you need to find you need to also read about all these investors also, because I read most of them, not all of them, but some of them. Then I feel that okay, I read through their philosophy, their investment strategy. I go to their website or something like that. Then I see, okay, this one suits me. I want to follow this investor. So I will keep track of what these investors are buying. Okay, so that's how you can do to track investors that suits your style. I hope I answered your question, Rachel. Okay. Howard Mark, I think he's more for bonds lah. So his stock also he's also generate very good returns, but mostly are from bonds and all this. But he do invest in stocks lah. But then yeah. YK asks, which super investor you are closely monitoring? Do you look at Li Lu? I think Li Lu is also a quite good investor. You also can consider him. Okay, Charlie Munger thinks highly of him. So Himalaya Capital, which is this one. Yeah, he also generates similar capital record also. So you can consider looking at this Li Lu also. Victor asks, can you share why you dislike Carl Icahn? Actually, basically, Carl Icahn is a corporate raider. Or activist. He go in and he just he go in and he just reshuffle the management, and he just, when the price go up, he will just sell it out of the company already. Okay, so I don't really like the activist style of investing. So that's not my style. Okay. Like for instance, like example, Bill Ackman, he used to have a very good track record, but in recent years, he keep making a lot of bad track record and also invest in the wrong company, selling the company at the wrong time and all this. So I don't really follow Bill Ackman. Okay, yeah. Any other super investor that you guys like, you can type in. I can share you my thoughts if I know. Okay. Yeah. So I don't really like Bill Ackman. So it's up to you lah. If you like Bill Ackman, you can go and follow him. You say Rusmin, super investor Rusmin. Rusmin name is not inside. Okay. Any other name? David Enhorn. David Enhorn. Greenlight Capital. I think this guy also short the markets one, but in recent years he's not doing very well also. Pat Dorsey, I think not bad. It's a new fund, but I don't know what's his track record. But he wrote the 5 successful thing, not bad. Okay, Ray Dalio, I think he's okay only. His track record not as super as the rest. Okay, I think Pat Dorsey, you can go and take a look. Very fundamental. Katie Woods, I won't follow. Guy Spider, I would say 50-50. His track record also decent only, not that impressive. Yeah. Katie Woods, I won't follow Katie Woods, right? She follow Katie Woods is someone who have been in the fund management business for 40 years. Only recently, then you know about her. It can tell you the track record. If I would like to have growing dividend long term, which super investor? Actually, I'm not sure. I don't think they buy for dividends. A lot of them buy for the a lot of them actually buy for the growth and all this. So I can't advise you on that. Okay, but I think if you want to buy quality companies, you can look at Terry Smith and you can look at Warren Buffett. Okay, what else? Okay, what other? Okay, this Robert Vinal is also quite a good super investor. He actually generates quite good return throughout the past few years. But then in recent years, he invested in the Carvana, and that one dragged down his whole portfolio. He actually is compounding at 30%, but because of that, right, he concentrated on that Carvana, and Carvana went down. He literally went down to, I think, only 15% compounding only. Qing Yao said AK for dividends. Yeah, you're right. If you're looking for dividends, go and look for AK. Okay. Bill Miller, I think his track record only is decent only, so I don't really follow Bill Miller. Just a typical value guy. Okay. So I usually want to follow those that the track record, they sustain very high returns, let's say at least 15% or above over a long period of time. Okay, so Bill Miller, I don't think he get 15%. I think it's about 12 or 13% only. Okay, Jim Rogers, I don't think it's inside this. I don't think it's inside. Okay, Munshi Prabhai, he used to be very good, but nowadays he's a bit weird also. Right? If you go to Twitter, if you disagree with him, he will just ban you out of his account. Recently, there's a lot of people talking about how Munshi Prabhai actually banned them. Okay, Seth Kamen, I think is one of the best. You can go and look at it. Okay, Seth Kamen, Li Liu, Warren Buffett, Charlie Munger, and all this. Right. Okay, so yeah, so this is how you look at the Data Roma. Okay, so and this is how I actually look at Data Roma. Okay, do you like it? If you like, just type yes in the chat box and let me know. So this is more in depth when it comes to the analysis and all this. Okay, so let's move on. Okay, there's still a lot to go. Okay, so next is to look at insider trading. That means insider buying. Okay, so like what Peter Lynch said, right? Insider might sell their share for any number of reasons, but they buy for only one. They think that the price will rise. Okay, so insider is also a very, very good way to find ideas. Okay, and I can tell you later how I found an insider. Then I increase my stake in one of the company. Okay, so when I say insider is what? Example, your chairman, your chief executive officer, your chief financial officer, chief technical officer, or chief operating officer. Okay, or all those very high level, senior level management. Okay, not independent director. Independent director buy, I don't want to look at it. I want the management buying. Okay, so when I look at the management buying, right, I want to see how much are they purchasing it, right? And what is the salary that they get compared to the amount that they purchase. Okay, so example, let's say the guy's salary is 5 million. Then he only buy $10,000 worth of shares. Then does not matter. To me, it's not impactful. I want to look at all these key personnel, but very impactful purchase. Okay. So now I'm going to play with you a game. I'm going to show you the management salary, one A and B, right? The management salary and the amount that they do insider trading. Okay, so you go and tell me which one will you trust. Okay. So now you have A on the left, right? That out of the 100% salary, right? They purchase inside, they buy the share into a company about 30% of their salary, and you got B. when 100% salary, right, they do buyback, right? They purchase, the open market purchase the shares, right? Only 2% of the salary. Which one will you choose? Which management do you think you will trust when you look at this? A or B? Type in the chat box and let me know, huh? Yeah. So yeah, definitely it's A, right? It does make more sense, right? So imagine, let's say you are the management and you think that the company will definitely make more money in the future or worth more. And you put 50 to 80% of your, let's say your latest year's salary in the share. Does it show that you have conviction in the company? Yes, right. But if you just put 2%, because I'm telling you this because I saw a lot of, especially companies, right, where the listed company CEO every time tell you, oh, my company is good, my company is undervalued. Then when he buy from the open market, right, he only buy like, let's say, example, his salary is like 1 million. He only buy like 10,000, 20,000, 30,000. It's not impactful. If it's really very cheap, really very good, then put more money inside. Okay, does it make sense to you? Yes or no? Type in the chat box and let me know. Okay, so I'm telling you this is because there's really some management, they really know that, hey, investors are looking at insider buying. So I just buy some share to show insider, to let them think that my share is really undervalued. I can buy only. Okay, if you really think it's undervalued, you'll buy massively. Okay, so that's my take on this. Okay, so how do you look at insider buying? Basically, you go to in the US, right, there's this thing called SEC Form 4 over here. Okay, so when you go to the SEC Form 4, usually you'll come to this page and you show that they are buying. Okay, so when they buy, right, you look at the code. Okay, there's a lot of code. So what the code that you want to look is actually the P. P is purchase. So you can see that the Form 4 got multiple codes over here. You got your P, S, V, A, D, F, I, M, all these, right? All are based on different shares, issuance and all this. Okay, the one that you really want to look at is P and S. Okay, I most of the time I won't see S unless, right, the company, the guy is selling very massive percentage of this is his share. That means, let's say, example, he owns 30% of the company. He sell off 20%. Then I want to look, hey, I own this company. He sold off 20% of his share. Do I still want to hold this company? So I only look at P and S. Don't look at the rest really. Okay? Timothy asks, could a reason for not buying more because it may trigger a need to a public offer or other regulatory restriction? Okay, so what happened is that in Asia, yes, right, they cannot buy back. They cannot buy back more because you're trigger. But in the US, right, in the US, usually very hard because the management owns small percentage stake in the company. Okay. David Lim say, thanks, Victor. I noticed Wilmar director keep buying, but not a big amount. Yeah, they keep buying, but it's not a big amount. Wilmar, the director, I don't think he owns a massive percentage, right? So he can still buy big if he wants. Okay. Philip asked, where can I get the replay? I think the replay will be sent to you, or if not, you can go to the Alpha, or if not, it may be posted on the Alpha Quadrant online. I'm not so sure how my marketing going to send to you. I'll check with him. WK asks, is it the same as Form 1 for SG? I think I'm not so sure what is SG form, but it's the same. You can get SG. Okay, but Singapore stocks, very hard to look at insider because like what Timothy has said, a lot of them owns substantial stake. So the more they buy, right, then they're going to trigger a mandatory buyout offer. Okay, I'm talking this in terms of the US capacity. Okay, Trisha asked, what is the website to screen for insider trading? Okay, coming. Okay, because I'm answering all the questions. Okay, so hold on. Okay, so any more questions first? If you got any more questions, just type inside. If not, I'm going to move on to talk where can you look for insider. Okay, free sources for you. Okay. Okay, I don't see any questions, so I'm just going to move on. Okay, so I'm just going to move on. Okay, so basically, right, you can go to this website called openinsider.com. Okay, so it's basically free free for you guys. Okay, Eric asked, how do we know about the salary? Okay, Eric already mentioned how to look for the salary inside the Alpha Quadrant Online under the management, but don't worry, I'm going to run through it now, okay, live with you guys, okay, so that you guys know step by step how to do it. Okay, I'm just running it through live. Okay, so Open Insider, right, is a free website. I think it's good for you guys, and it already shows like the purchase and all this. Okay, so you just click on purchase, no need to click on the rest. Okay, purchase is basically they use their own money and buy off the open market. Okay, so you click on the officers, which is all the main player and the director. Do remember, like I told you, ignore independent director. I want to be executive directors. Okay, then maybe no need to last 2 years, maybe the last 1 year. Then maybe you put a lot in one page, then you just search. So you can see. Right, CEO, COO, all this. Right. But you look out for companies that I mean the big one is when they keep buying. That's the best. So you can see the amount that they add from here. Okay. So recently what happened is that I saw this. Let me check. Let me see. Okay, maybe at the second page. Okay, there's a lot insider, that's why. Okay, let me see. Okay, I don't know how this thing do, but it does, because I think every day there's a lot insider buying. So that's why it overtakes the previous one. Okay, so what happened is that while I was doing these slides, right, I saw the market access CEO do an insider purchase. Okay, the new CEO of Market Access, right? If you've been through the Alpha Quadrant Online, I actually shared this company called Market Access with you guys. How many of you actually remember? If you remember, just type yes in the chat box and let me know. Okay, so I know you guys know the company. Okay, yeah. So basically, I saw the new CEO of Market Access went into the market and purchased, I think, 1/million in terms of the value, 1+ million of the Market Access share in the open market recently only. So while I was doing this slide, I think I'd done this slide about 2 weeks ago. Okay, so I was screening it. Okay. And okay, let me see. I can screen by CEO so that I can easy for me. Maybe CEO screen like that easier. Maybe I can screen out. I need to find the market access value. I see. I saw it. So basically I saw this. Okay, I think you screen by CEO, directors and all this. Okay, so I saw this Christopher Concannon, right? Cannon. He up about 1.012 million. Okay, so then I went to the market access. So for example, I go to market access. I go to market access website. Then I go and look for his salary. Okay, so I go to SEC filing over here. Then I go to proxy statement. Okay, I think it's this one. Let's see. Let me see. Yeah, it's this one. Okay. So I go to proxy statement. I go to the compensation table. Then I see Chris Concannon 2022. The salary is 4.3 million. Okay. And 4.3 million. Then he bought about 1.01 million. Is it? What's the amount just now? Let me check again. Where is it? 1.02 million. Okay, so you type 1.02, right, divided by 4.3 million. What's the percentage? Type in the chat box and let me know. What's the percentage? What's the percentage? About 25%, I think. About there. About 1.0. Yeah, about 23 point something percent. Okay. So I see, actually it's quite a huge amount, of the salary. So I decided I said, okay, we increased stake on Market Access. So recently we bought into, even I also bought into Market Access further. Okay. Moreover, when I look at the share price, I feel it's a decent value, right, for a company that is still in a growing industry, still got a lot of growth. Right. It's just temporary setback because the previous record it set was very high because of the COVID pandemic. Okay. So it must be significant. Joyce asks, what is deemed as meaningful percentage? You have to really ask yourself. You ask yourself as a management, if I really think that the company undervalued, but I buy only 1 or 2% of my salary, do you think it's a meaningful percentage? No, right? But if I were to buy like 20%, 30%, 40%, 50%, or maybe 80% of my salary, it does speaks volume on that. Okay, so that's what I'm trying to look out for. Volume. Okay. Okay, so let's do live another company. Okay. So from here, right? Okay. Okay, so many company. Okay, from here, from this list over here, choose one company. Qing asks, do we need to consider the share he got as an executive compensation? No, I don't look at the share because that are given to him. The one that I show you is the one that he purchased off the market himself. That means he really take his own money and go and buy. That one, I don't look at it. I look at the one that he really take his own money and go and buy. It speaks volume. Okay. Okay, choose one company over here. Trisha asks, is the CEO buying share per month? No, he just buy one time only. I just saw it only when I was doing this slide. I said, oh, interesting. Chinga asks, for CEO own purchase share, are they restricted in terms of when they sell? No. Purchase share are not restricted. Steven say real. That's real. Okay, so this company lah. Okay, this one is the CEO. Okay, so let's look at real REL. REL investor. Okay, so you guys still type. Real. The real. I don't know, is it this one? Okay. Let me search the. Let me highlight the company name better. Seems like it's this company. Okay, let's double check again. Is it this company? But how come the name is so different? No, I don't think it's the company. I cannot find the investor relation. Okay, never mind. Give me another company. Give me a company. SCTL. Where's SCTL? Okay, SCTL. Okay, this one looks interesting. Okay, let's look. Okay, let's go. Okay, go to the SEC filing. Look for proxy statement, which I think is this proxy statement. Yep. Okay, proxy statement got a lot. You must find the one that is correct one. Let me see. Okay, this one correct. Got the content page one is usually correct. So how much the guy bought? 2.5 million. Okay. Where's his salary? Director compensation. No, this one. Okay, again. Not long one. Usually it's a summary table. Give me a minute, Executive compensation. Okay, what's the guy's name? And where's Matthew Paul? Okay, let's see. Okay, can't seems to be. Where's the guy's name? Rachel asked how do Open Insider and Finviz different from doing Insider. I don't think the Finviz can do the search. If you want to search, right, you have to really, you have to really what? You have to really pay the money. Okay. Wrong side. Matthew. Okay, some of you say he's just a director. Or that director, I want to look at it. Okay, I want to see the one that is like the C-level really running the business one. Okay, but I just for the sake we just look for him Arens. Okay, try to find his salary. Don't have he's just a director. Okay, so never mind, it's okay. All right, but yeah, just look. We want to look for the C-level one. Okay, the C-level personnel. Okay, so let's say example. This one is the CEO lah. Okay, this one easier lah. Knee source. Okay, we try this. SEC filing. Where is it? Filing. Okay, proxy form. Okay. Okay, 52. Okay, here. Okay, so what's that guy's name again? Okay, YATES. He bought about 1.05 million. Okay, so here. So his salary is 7 million. So 1.05 divided by 7.13. So what's the percentage? What's the percentage? What's the percentage? 14.7%. Yvette say 14.7%. Do you all get it? Okay, so based on 14.7%, right, how many of you, right, thinks, right, it is meaningful? Yes or no? Just type in the chat box and let me know. Do you think this is meaningful? Okay, some say yes, some say no. Okay, so it really depends, right? So I mean, anything below 20% is a 50-50, okay? But I think 20% or above is I think a sure thing, as long as you can take 20% of your income and go and buy it, right? I think it's 50-50, okay? So I think just now there's a question by May E, is it? May E say from Yahoo Finance, the Christopher Robert Concannon pay about 1.81 million. I think you have to look at the proxy statement. Don't look at Yahoo Finance. Sometimes they collect the data, I'm not sure. Okay, so yeah, so that's how you look at the thing. Okay, so let's look at I think some of you actually talk about Wilma. Let's look at Wilma. Okay, let's look at the annual report. First, we need to see whether the Robert Kwok, the Kwok Jun Hong, how much percentage he owns in the company first. Because in Asia, a bit tricky. If he owns too much percentage, is no point. They cannot buy a lot. Okay, where's the annual report? Yeah, over here. So let's say the annual report. Scroll all the way down. Usually the shareholding structure is all the way at the bottom. Over here. Okay, so let's see Kwok Jun Hong, which one did he own? Joint venture. Kwok Jun Hong he owns about 13.15%. Yeah, but I think he also got deemed interest in like Kwok Brothers and the rest. So I don't know what's the actual big percentage. Because in the Asia, they are always not so clear one. Okay. Okay, how much did he bought from the market? Anybody know? Can type in. I did not track that. But how much did he bought? How much did he bought? What's the percentage? Oh, so many files. Okay, anybody know what's the actual? If not, I do. You see, he bought so many times, so very hard for me to calculate one. It's very tedious for now. Okay, let's roughly look. He increased by 0.05% for the first purchase. 9 million shares. He bought 9 million shares. So his deemed interest is about, it's small amount. Because you see, his deemed interest number of shares is only 823. He owns 800 over million. 9 million over 800 over million is a very small percentage. Right. So I don't think there's any effect. Right. I think he just feels it's cheap, then he just buy it. Okay. I think Realma is, if I'm not wrong, it should be quite reasonable now. I'm not so sure. I've not been tracking the company for a long time. Okay. It's more of a dividend stocks. It's not for growth. Okay. So hope you guys like the insider. Do you like what I just taught you? If you like, just please type yes in the chat box and let me know, so I know you guys learned something. Okay, I think you guys, thank you so much. I hope you guys learned something. Okay, so let's move on. Okay, so the next one is actually, we look at share buyback, okay? So why do we look at share buyback is basically, do you remember this stock return formula inside the Alpha Online? The Alpha Online that I created for you guys, right? So I told you that the stock return, right, is basically your earnings growth multiplied by the change in PE and the change in share outstanding, okay? So I told you that the PE, right, you cannot control one. That one is depend on the investor view on the stock that the PE can expand. And most of the time, the PE can expand, right, is only simple business, recurring business, and asset-like business, okay? The one that can control is actually the earnings growth and the change in the outstanding share. So the change in outstanding share is, as long as you keep reducing your share, the earnings, even though let's say it grows at 8%, but you reduce the share at 7%, let's say the PE multiple don't change, the stock will grow at 15%, okay, because 8 plus 7, okay, so that is basically the stock return formula, okay. So just a quick recap on this, and if you were to look at Warren Buffett, right, recently, right, he had bought into all those Japanese companies, and if you go look at those Japanese companies, right, they generate very decent return on investor capital, right? They hold a lot of cash, and if you go back and look at let's say around the early 2000, right, Japan has been cheap for a long time. Even the early 2000, Japan also has been cheap. Okay, so if you go and read the old Berkshire Hathaway AGM, right, in the early 2000, right, Japan was brought up by him, but he was not interested in Japan, right, despite the stock was already cheap during that point of time. Okay, because he says that the ROE, right, was too low. Okay, the return on equity is too low. But why? But why? Why now? Why now? Do you know why now the Warren Buffett actually looks into the Japanese company? Why now? Can you type in the chat box and let me know? Why now? Why last time he knows it's cheap but he don't buy? But right now it's cheap, but why he buy? What's the difference? Type in the chat box. Said government allowed share buyback. Yes, that's the difference, because the Japanese stock exchange actually announced that they're going to do the share buyback initiative, right? And a lot of the Japanese companies, they hoard the cash, right? And they now going to take the cash out. They keep doing buybacks, right? And Buffett knows at this kind of value, so cheap, and you keep buying back, eventually the stock price will go up. So that's why he has been buying into the Japanese company. Okay, so what I'm trying to tell you is that you have to watch out for companies that announce like share buyback, okay, and not immediately buy. Okay, you look at Warren Buffett, right? When if you go through the share buyback module online, right, I already told you he don't buy immediate. He looks when the company really start buying back shares, maybe 1 year or 2 years, right? Then he will go and buy into the company. A company prove that they really buy share. Okay, because a lot of companies, they can announce share buyback, but they don't buy back. You get what I mean? Announcement is very cheap, very easy. Okay, so do take note about it. Okay, so the Chinese the Japanese companies actually announced they increase the buyback and also the dividends, right? Which will eventually all this will drive up the return on equity. Okay, if you look at the recent Occidental Petroleum that he bought, right, it's also the same thing. Occidental Petroleum, they reduced their asset by 30%. They increase their free cash flow. They take all the money, right? They keep doing buybacks and dividends, and they return capital to the shareholder. And that's why Warren Buffett, right, previously, he was just supporting them through loans, but after that, he bought into Occidental Petroleum. Okay. Another example is you can see, like, when you see company announce share buyback, right, and they really buy back, is, for instance, let's say, you remember just now I talked to you about this super investor called Norbert Low, Punch Card Management. So this guy, right, many years ago, right, in 1997, right, he spotted MVR. So if you go and look at MVR since 97 until now compounded 20%, excluding, I think they did not give dividend. Let me check again. Let me check. MVR got dividend. Yeah, they don't pay dividend. But MVR compounded about 23% over I think 20-30 years period. Okay, he spotted this company. How he spotted was that time MVR was a small company, and this company, example, the market share was, like, say, example, 500 million. Right? They announced a 250 million share buyback program. You know, so when this caught his eye, then he went to track the management whether they got share buyback and all this. And after that, MVR is a multi-bagger for him. Okay, so there's also an idea of how you can look for companies. Okay, so the sad part about share buyback in US as compared to Asia, right? In Asia, right, when the company do share buyback, they can announce inside the announcement, especially Hong Kong and also in Singapore. Okay, but in the US, right, there is no announcement for this share buyback. There's no like reporting to SEC on this share buyback. They every time announce, they just announce it on their own company website. They no need to report on the SEC that they are buying back the shares and all this. Okay, even if they don't announce, right, they also can just continue buy it back because it's not a requirement. It's not a new rule for SEC. But don't worry, SEC is like changing the rule that they have to disclose the share buyback already. Okay, so it still haven't changed yet, but the rule is changing already. Hopefully, it will go into SEC. So when it's go to SEC, it's easier for you to track. Okay, if not now, you only can just keep, you read the company, then you know, or you read some newspaper, then you know. Okay, let me answer some question. YKR, so is share buyback good or bad thing for investor? It's good thing if the value of the company is cheap. So that's why you need to know how to value the company. Okay. Okay, how relevant is share buyback for SG stocks since most companies pay or dividends which are tax-free? Okay, it's not relevant. Share buyback is more relevant for the US stocks. It's not relevant for Asian context. Why? Because firstly, Asian context, right, the dividend is tax-free. They should pay out the dividends. Second is that majority of the owner owns significant stake in the company. So if they own 60, 70% of the company, I don't want them to do share buyback. They do share buyback will only reduce the liquidity of the company, and also you enrich themselves more, which I don't like it. Okay, which is the case of what Silver Lake is doing, which I don't like it. Okay, I hope I answered your question. Why WK? Okay, so how do you track share buyback? Okay, so that's why I say this is the only hardest part that you can do. It is very hard to track. Okay, you really have to have. I don't know if there's screener. So far, what I found is that you can screen through this thing called buyback yield. Basically, you take the total value of the share repurchase divided by the beginning market cap of the company, right? So far I found another website, right? Which is this thing called Finbox. I can show you over here. Finbox.com, FINBOX.com. Okay, but the thing about this, right, is it's not a free account. Okay, so for instance, you just buy back you greater than 0%. Okay, but you see it's a premium account. I thought it's free, but in in the end, it's actually it's not free. So I didn't I cannot recommend to you. It's very hard to find. I keep finding sources for share buyback. It's very hard to find. I think you have to really pay if you want. Okay, there's no free sources. Very hard to find free sources for this. Okay. Daniel asked, Nvidia announced 25 billion share buyback when their share price is so high. Perhaps too much cash, nothing else to do. This kind of share buyback, I don't think is good because the value of the company is very expensive. So when they purchase back at a high price, I don't really like it also. I rather they give back the money to you. Okay. Okay, so alternatively, what I can do for you is that, give me a minute. Actually, I already help you to screen out companies, right, that have share buybacks already over here. Okay, so you can go and look at them. I will upload it to the Alpha Quadrant online. So you can, I'll get Adam to upload it to the Alpha Quadrant online so you can download this Excel from there. Okay, so basically there's about 3,000 over companies that do share buybacks. Okay, but they do share buybacks, but does not mean that the share count will reduce because they also do issue shares. Okay, so you have to go and see one by one whether they got reduced share count or not. Okay, do you like this Excel that I'm going to give it to you? If you like, just type yes in the chat box. Let me know. I screen out for you. I clear up for you nicely, and I also put the industry for you over here, so you can use the tab and all this. Okay, I'll get it upload to the Alpha Quadrant online, like I said. Okay, so you guys can start from there. Okay, I give it to you is because there's no free source on that, so I just create for you because we have a paid service using the Capital IQ, so it's easier for you. So you just get it from the Alpha Quadrant online. I will either upload the next 2 days. So give me some time, don't rush me. Give me some time to upload for you. Okay, so let's randomly look at few company. Okay, so now I'm going to just scroll and you just tell me which company you want. Okay, I wait for it to stop. Okay, just randomly choose one company, then we just look through it. Okay, from this. YK asked, do you know what share buyback Warren Buffett was looking at before he bought the Japanese broker? I think the Japanese broker he bought because he looked at the value of the company is cheap and they're doing share buyback. He don't look at the share buyback yield. He look at companies that are cheap, right? That means the value is cheap and they do share buyback, right? He don't look at buyback yield. Buyback yield is a way for, like, I help you to screen and all this. Okay. Okay, what company? Apple. You guys are funny, man. Apple, I think all of you should know about Apple. Right? Why do you want to do Apple? Right? We do some companies that you don't know. You understand? Apple, I think most of you know about Apple. Don't talk about Apple, right? Talk about something that you know. Okay, NSYS. Okay, DG say NSYS. So NSYS is this company. Okay, so NSYS. Okay, let's go to RIC.ii and look. Okay, did they do share buyback or not? NSYS, where's the US one? This one should be the composite. Okay, NCS. Let's look at the share count. No share count? Okay, we are. I do not RIC.ai got the share count. Give me a minute. Let me find. Share. Okay, so you see, NCS is reducing the share count. Okay, so they got increased. Then after that, from 93, they slowly reduced lah. You can see from here. Okay, so this one pass your criteria. They reduce the share count. So you look for companies that reduce your share count. Even they don't grow so much, right? The reduced share count will help to push up your share price. So don't worry about that. Okay. Samuel said AppFolio. So let's look at AppFolio. Okay, let's look at AppFolio. Basic. Okay. So they do share buyback, but then they also got dilution. So there's no reduced share count. So this one is a no-no. Anka. Is there Anka over here? ANKA. You mean Anika, is it? I think you no need look lah. This company confirm no share buyback because it's a biotech company. They got confirm no profits on. They playing on the patent. Okay, let's Baba. Okay, some people say Baba. Which one? Baba is under NYSE or I think it's under this one. Okay, Alibaba. Let's look at. Oh, cannot see. Okay, wait. Okay, this free sources. If you want to pay, you just pay. Let's look at this. Cannot see. I don't know why they don't allow you to see Baba. Okay, anything else? Any other company? Okay, Apple. Just now you all say Apple. I give it see Apple. I thought they give free for a lot, but then they still take out certain companies. You see Apple. Apple, you can see is reducing. You'll notice Apple, you see, they didn't really reduce until I think 2013 onwards, they start to reduce, you see. And that's also when the time where Buffett bought, And you see they reduced significantly a lot. Okay. Anheuser Brewery. Let's see. Anheuser Brewery. Okay, it's in the US, right? Okay, I assume it's in the US, so I just click. Okay, Anheuser Brewery. They blocked me. So you have to pay. Okay, the free one is not there. Okay. Hard to find free stuff. I try to give you all free stuff. Okay, Fastly. Some people say Fastly. Fastly. Is it under NYSE? Okay, let's just try. Okay, did not block. Okay, let's see. Massive dilution. Okay, so that's how you should look at the share buyback. Okay, so these are one of the sources. Okay, so don't worry, I'll upload the Excel in the Alpha Quadrant online for you guys to download. Okay, so so let's go back to the slide. Okay, give me a minute. Okay, so next one is we want to look at the 52 weeks low. Okay, so if you look at this guy called what's this guy's name? Alan Mitchell. Okay, he actually says that the average stock price fluctuate roughly 80% annually, right? When comprised 52 weeks low and high. So in 1 year, right, the stock will just keep going up and down. Okay, up and down. Okay, so that means there's always chance to buy 52 weeks low one. Okay, and why do we look at 52 weeks low? So when a company, right, most of the time when they trade at 52 weeks low, that means I can tell you one thing: a lot of bad news. A lot of investors don't like them. Okay, but that is also the case where there's a lot of value, because I can tell you most investors they overreact for the company. So that's where it gives you the opportunity to look at companies that are very good and they are selling at a cheap valuation. Okay, if you can prove that the mass majority, right, is wrong. Okay, so that is your job as an investor to do. Okay, so this method, right, will produce very good returns for you, but it requires also the most work. Okay, because you have to look at the company, then you have to go and see what is the, you go and look at a company at 52 weeks low, then you have to go and see what happened to the company. And you must ask yourself, is it temporary or permanent? Okay, so in this case, right, you can look at this company example, let's say Meta. Okay, if you look at Meta, right, especially last year, this is based on 2022, last year, right, they hit their 52 weeks low. Okay, and these are all the reasons that shows how they are declined 76.7%. Okay, firstly, because they focus on spending on metaverse. They got strong rivalry from TikTok, but they're still making money. They're still making profits. They increase spending on the capex because of metaverse, and the revenue start to decline. Okay, the revenue start to decline because in 2020 and 2021, right, there's a boost in the tech, so the revenue increase. Okay, but 2022, right, revenue start to decline because that was a very high figure to look, and they focus on spending unnecessary 10 billion, right, every year burning 10 billion on metaverse. Okay, and investors don't like it, and they slam the stock down all the way. Okay, and at the point of time, you know what's the valuation of Meta? 9.3 times. That means you are buying 9.3 times PE on Meta. Okay, but if you think about it, right, the metaverse, right, as long as they cut the metaverse, they will come back at it, right, the profit, because the profit is down because of the metaverse. Right, the revenue, yes, is down, but the major cause of the profit down, right, is actually the also metaverse that push their profit down like significantly. If I guess only a lot, 20-30% drop in the profit because of the metaverse. So the moment, let's say this Mark Zuckerberg reverse everything, everything will come back at it. Okay, I can tell you, at that point of time, I tell you, a lot of people are avoiding Meta. Okay, nobody's buying. I tell you, I own Meta. I bought Meta around here. It went all the way up and went all the way down. But I didn't sell my Meta stock because at the end of the day, I tell myself, and they're doing share buyback, the valuation is cheap, and if they were to stop the metaverse, the thing will revert by itself. Okay, so that's why the key is when you see this kind of 52 weeks low, you must ask yourself, is it permanent or temporary? And what scenario must happen, right, that the thing will switch? Right? For me, I understand the moment they stop spending on metaverse, they cut costs, everything, right? Everything will be back, right? So when you look at all these companies, right, it's not that you want to go in, right, and look at every company. What you want to do is you want to go in, you want to look at all these companies that go to the 52 weeks low. Are they asset light? Are they generating good return on invested capital? So if you look at Meta, right, even though they drop so much at that point of time to 9.3 times PE, they are still generating 39.3% return on invested capital. This is the first thing. Second, the price is value, and they are having a net cash of 11.4 billion. Okay, that means this company will not go bankrupt. And the way TikTok fight them is still not immediate threat to them yet. It's still a long way. Okay, so that's how you should go and search at 52 weeks low. Vic asked, did you buy more Meta at 52 weeks low? I did not, because I maxed out my allocation in Meta, so I didn't want to increase my stake. Okay, so at the end of the day, as much as you know it's cheap or not cheap, you still have to stay to your allocation. Okay, unless you are very confident in the company, then you can go on. You can go and put it some more. Okay, so for me, I decided to stay with my my allocation percentage. Okay, so that's how you should do it. So how do you screen for 52 weeks low? Now let me show you. Okay, so you go back to Finviz. Okay, let me clear this filter first. How do I clear it? Okay, I think it's at technicals or something. 52 weeks low and high. So you want to buy like when it bounces a 52 weeks low and above, okay? It's like maybe 5% or more above the 52 weeks low. Okay. So if you want to, so you see you got 7,000 plus companies to look at. Okay. But of course, if you want to be more specific, right, you can screen by the revenue growth. That means the company already still have 5% revenue growth. Gross margin 20%. Even though it drops, right, still profitable. Okay, but I won't want to look at this because sometimes the company drop into negative can be temporary. So I'll look at these two. So you see from the just now, I think 7,000 plus now drop until 1,000 plus. So you can go and look at all those companies. Right now they are at 52 weeks low. Right, just 5% or more from the 52 weeks low. Then you see, hey, is there any value that I can get out of this company? Right, so that's how you should screen for 52 weeks low. Okay, I do get some ideas for here from time to time. Okay, I always like to look at companies when they hit 52 weeks low. Okay, I don't want to brush it off. Okay, I tell you, most investors will brush it off. But if you want to create alpha, you want to go against the crowd, you have to think that the crowd is always wrong. And when you go inside, right, you want to see, okay, what value can I find from this? Okay. Do you agree with me? If you agree with me, just type yes in the chat box and let me know. Okay. Of course, not every companies can, some companies can come back, some companies cannot come back. But at the end of the day, when you make the decision, when you look at 52 weeks low, is to find the most quality company that you know that the risk reward is high one. Okay, so for instance, like some of you talk about C right now. Okay, so you talk about C. I can see from here, you talk about C, right, which is C Limited. So that company, right, I mean, first, the competition in their Shopee is very tough, right? So right now, Lazada is also coming in, and it turned profitable, and recently they say that they're going to start spending again, so it's probably going to become loss-making again. So last time we bought into C is because, right, that YK said, interesting to see Apple here at 52 weeks low. So I put the benchmark is 5% or more. So that means they are 5% or more from the 52 weeks low, right? So they may have gone up very high already. So that's what I'm trying to tell you. Okay, you try to find those that is still closer to the 52 weeks low one. So it's not a best screen, but then it still give you some ideas from there. Okay, let's back to C. Okay, so in the end, in the past we do buy into C, but we didn't average down because we bought into C because they got a profitable arm that is funding the loss-making one. So still not so bad. So in the event where they clear off the loss-making one, the profitable one still profitable. Okay, but the case for C right now is the profitable arm, right, which is their Garena and their app, which is the Free Fire, right? Free Fire got banned in India. It's one of the revenue generating place for them. Okay. And for this type of game, right, mobile game, right, eventually they will die out in terms of the popularity one. So it won't be there forever one. Right. So I feel that they already die out. Their Garena is not that strong right now. Okay. So that's what every investor thinks about it. Okay. So in order to go against the crowd, right, you need to think that, okay, the Garena can make a comeback. So if the Garena can make a comeback and the Shopee can stay profitable, then you prove that investor were wrong. Then the whole share will switch back and shoot up like a rocket. Okay. But the thing is, I must ask myself, do I think it's possible or not? So at any point of time, you have to ask yourself, do you think it's possible? And the value of the stock, is it cheap right now or not? So this is the two things that you must look at when you look at companies at 52 weeks low. Okay. So if you agree with me, just type yes in the chat box and let me know. Okay, so I hope you guys get the concept. Okay, I hope you guys get the concept. So yeah, so basically this is how I do my screening and how I look at all those companies. Okay, so right now I just will go through some Q&A with you guys. Okay, I think some of you have submitted the Q&A up front. So I'm just going to just go through some of them, but I can't answer all the questions that are submitted up front because some of the companies you talk about, I may not have any knowledge about it. Okay, so for instance, let's say Ho Wai Kam actually asked, I have always wondered which of the government-linked, previously low-risk companies are worth investing in. The likes of ST Engineering would appreciate if you could touch upon at the Sunday webinar. Okay, so So the ST engineering, I'm not so sure. I think Rusmin covered extensively on ST engineering. So for me, I do not have really ST engineering knowledge on it. Okay, but to what I see, they are sort of like a defense contractor to the Singapore government. So I think they tend to be much more stable and they should be always there one. Okay, so I think not on concern for any disruption for ST engineering. Okay, but a lot of the other government linked business, right? They are being disrupted. Like for instance, your Singtel, your ComfortDelGro, all this. I feel they are being disrupted. Okay, so for SBS and the rest of Vicom, all this, I think still not so bad, still stable at this moment. Okay, so that's my take on it. Okay. Rachel asks, may I ask what is your personal process of generating investment? Those five steps is the step that I use it personally myself. That's what I share with you today. I already explained it in the start. Right? These are the 5 ways that I do it myself. Okay. Glenn asks, is market access still a buy? Its price has been coming down and the P is 36. Okay. Glenn, why don't you do the P chart on market access and send it to the Alpha Q&A and let me know whether it's cheap or not. Okay. From there, I will follow up with you. Okay. Please do type your thesis inside and run through the checklist. Then I will go through with you from there. Okay. So let's move on. Okay, Theo asks, I have a few REITs which have a loss from 36% to 96%. I'm at loss of what should I do, means to sell it off or not. Some of my profits, stock dividends are at about 4% only. Will be retiring at the end of the year. I need to be more defensive. I started to buy SSB too. May I seek your advice? What is the best approach? Okay, so firstly, I don't know what REITs you bought. Okay, if you bought the quality REITs, I will tell you probably to hold on and also to increase the stake on those REITs because I don't know what REITs you buy. But if you own all those like US office REITs, then I got a big concern. I think I won't want to hold the US office REITs because they're going to have very, very tough situation and it does not take immediate to resolve. It's probably going to take years to resolve that issue. So if I'm owning US office REIT, I will not want to hold it. I will actually sell it off myself and maybe allocate to somewhere else. Okay. Okay. Another guy from Manfred say, usually in what kind of business do you use the appropriate valuation method? Do you have such a table to determine which is the appropriate to use and what kind of business? Okay, like I told you, most of the business, predictable business, should use PE ratio. Okay. Only companies where the cash flow is 2 times the net profits, then you use price to cash flow. Asset companies, you use price to book ratio. Okay, other than that, I think no need to use other ratios. Okay. YK asks, do you use Seeking Alpha for investing ideas? There seems to be a lot of unsound results, insights, and superficial writer. Yeah, YK, I don't use Seeking Alpha. Okay, because a lot of times I feel Seeking Alpha, some of the writers they just write very surface things, so there's not much value to that. Okay. But what I use for Seeking Alpha is to track companies first thing. Second is like if anything happened to a company, right? Seeking Alpha writers are the first one to write what happened to the company. So I will usually go and read, okay, what happened to this company? Why the share price has fallen? Okay, like a brief history of the company. That one Seeking Alpha writers are very good. And that I don't really look at their analysis. Okay, I so far have not find any good Seeking Alpha writers. I hope I answered your question. Sumei asks, do you look at macro as well before going down to the country or industry level? I'm more of a bottom-up approach investor. So I will look from the company first, then I'll go and look at the macro at the last. Okay. So Manfred also have another question. He says that I'm researching one stock, ticker PSA. Okay, let me check what's PSA. Okay. Wait, let me finish this question first. If looking at its matrix, there's a lots of favorable trend. I've yet to finish my thesis, but I attach it in the email. Okay, I've not looked at your thesis yet because I do not want to affect my way of thinking in this company. So I'm just going to probably look through the company live right now. Look at the trend, the financial statement, and create graph to see how well the business is going in the easy part. So is the formula. However, the tough part lies in the economic mode. Morningstar award a no mode for this to the company. I can't agree with it, despite USA's netizen told me that self-storage is really helpful for them. extremely high profitable, low capex, not asset light, but this I can accept because of the business model. Is it a profitable business, but no economic a deal breaker? Okay, so if it's a profitable business and not economic, it's not I don't think it's a deal breaker. Okay, but of course you can buy, but I won't want to hold long term. Okay, I only hold long term for companies, right, that have economic mode. So if the company value become very expensive, I will tend to sell it. Okay, so I think this company is called Public Storage. Okay, so from that way I can roughly see it's sort of like an asset companies. So if you want to value this company, right, you should value based on price to book. Okay, so let me go to do a quick look about this company. I'll give me a minute. Okay, let me change it. Okay, so let me go a quick look of this company. Okay, Public Storage. Okay, so basically they own physical assets. Okay, let's look at just quarterly. Just look at what exactly the business is. What's the present? Oh, they know presentation slides. Okay, I just home to see roughly what the company. Okay, so basically it's a storage business Okay, but I don't think storage business have a mode, right? In Singapore they don't do that, but on US case, they tend to store in, because they are space in they have a lot of items in their house, so get cluttered, right? So they all put in the storage in the US. It's very, very common. Okay, so I believe this company is an asset heavy company, if I'm not wrong. PSA, let's look. Yeah, so if you look in terms of the return on investor capital, quite low. Okay, so I'm not saying that this company cannot make money. It still can make. Probably looking at the return on investor capital, right, it's quite asset heavy. So, and it grows, you have to get another land and all this. So I think probably maybe 10 to less than 15% returns over a long period of time. I'm not so sure. I have to go and see, but they do pay good dividends. Or it's a REITs, okay? PSA is a storage REIT, okay? Okay, so if it's storage REIT, it's a bit different, okay? It's a REITs, then you have to look at it like a REITs. Thank you, Steven. Okay, so I think the best way to look at is their price to book ratio to look at the value. Okay, so I look at the ratio. Yeah, so they definitely heavy geared because it's a REITs. Okay. Okay, let me look at the valuation. Okay, I've got no opinion for this. I think you still can buy this company, but you look at the yield and the price to book to buy into a company. Okay, I just do a quick one now. Okay, either you go to the use Y chart. If not, Y chart you can go and calculate the price to book But for my this case, right, I just use my Capital IQ just a quick one for this Public Storage. Okay, this is the main software that we are using at the fifth person. Okay. Okay, just do a quick one. Just for all of you I just do a quick one. Do a quick price to book. Okay. Yeah, they have dropped a lot, but they are still above their 10 years average price to book ratio. So I don't think it's cheap at this moment. Okay. Yeah. So that's my take on this company. Okay. So I hope I answered your question. Okay. If not, I think I want to answer some of your question here. Okay. So let me see. Okay. Okay. So I come to the end of my webinar already. Okay. So I'm just going to answer a few questions for you. Wow. I've gone through about 1 hour plus already. Okay. Let me see. YK asks, are you currently investing ideas at Japan, such as Nintendo, or Australia, such as Constellation Software. I think Constellation Software is not Australia. Constellation Software is US, right? Constellation Software is expensive right now, but it's quite a good management on that. Okay, I'm not looking at Japan. Okay, a lot of people are in Japan right now, so I'm not looking. I like to look places where people are not there. Soon Hui Has, on a daily and weekly basis, what do you and the 5th-person team read, research, or do to keep yourself up to date on the company? Actually, we read newspaper, your Wall Street Journal, Straits Times, The Edge, all this, yeah. And then analysis is on a daily basis on. Matthias asks, another stock research in Aiden has fallen to 52 below. Does 5% intend to update on the research video? Usually we don't update the video. We only update the things our finding inside the forum. So you can go to the forum. You can ask that, like, because I don't cover Aiden. I don't cover that company, so I don't have insight on it. Okay, I think it's Leo who covered the company. Fon asks, UOB and Hong Kong Land has been share buyback recently. Any comment? I think UOB generally they always share buyback so not much but the Hong Kong Land one, I think I think they want to reduce at least 10% share count. I think they did the good move because first their share price is cheap, second the value is cheap also, and they're going to reduce 10%, which I think is good. I think it's positive for them. Okay, CapitaLand Escort Trust considered quality REITs, growth up but falling net income. That's not good. Any insight? I don't have insight on that company. But I think Bruce may have more insight on that. Okay, I can't give comment on that. Okay. Danny said 5% is looking at Hong Kong stock right now. Yep. We are looking at Hong Kong market right now. It's a lot of companies. A lot of companies that are very cheap, selling at ridiculous price. Okay, if you want to know, this coming Wednesday YouTube, we're going to launch a YouTube talking about China market. Right, we share a lot over there. You can go listen. Okay. Vishu asks, is it a good lead to look at Japanese company that Buffett and invest in? Yes, you can go look at them. They are still, I feel they are, some of them are still reasonably priced, not expensive right now. But of course, some have pushed up quite high. You still can look at those companies that Buffett buy. Yeah, any more questions? Trisha asks, any idea why Mapletree, Pan Asia, Trust have fallen? I can't remember what's the reason, but I think generally the it's not only them the whole stock, some of them have fallen also. Okay, I don't have any idea why they have fallen. Prime US and United Hemisphere REITs are very low. Are they risky? We have not looked at them yet. Okay, usually we track the REITs for a long time. Okay, usually those latest IPO REITs, right? I don't really look at them. Okay, Clay ask any thoughts on Grab? I got no thoughts on Grab. As in, I can share my perspective on Grab. I think it's very hard for them to turn profitable first, right? Because first they have to go to different countries to expand, right? Because Singapore is too small already. So when you go to different country, you have to learn the culture and build. And next is, I feel like when you subscribe to the Grab $5.99 monthly subscription to get the deal, right? I don't think that's due. It don't feel value to me. Okay, eventually I cancel it. Okay, and not only me, a lot of my friends also don't feel value to it. I don't know you guys, do you feel value the $5.99 every month? That you really feel that you save money, that you have to keep subscribing? I don't think it feel value. So unless they change the thought on that, like that create value, right? If not, I tell you they will be loss making for a long time. Okay, DG asks, why is Tencent fallen? The Chinese sentiments have been very bad recently. Sun Hui asks, for someone who planning into investing full time, what would you recommend he or she to prepare and start doing? I mean, if you are going full time on investing, then you make sure that your passive income are covered. You can survive based on the passive income. Okay, when you start investing, please do not rush, because especially you're doing full time, please do not rush please do not rush to invest in companies, right? Do your research properly, take your time and be patient, okay? Because what you have is really time. Okay, a lot of time when people they go full time, then they feel, hey, I need to invest faster, I need to deploy my cash faster because I'm not getting any income. Please do not do that. Okay, read news daily, right, and create a habit to research on a daily basis. YK asks, how do you determine the share compensation are dilutive? I mean, I think it becomes very dilutive when, actually not very dilutive. I mean, it means excessive, is it, compensation? Because if they keep increasing the share count by like 10% or 20%, that's very dilutive. That's what I'll say. Someone asked about Venture Crop. I got no take on Venture because I haven't analyzed them. But I was wondering why over the past 2 weeks the Chinese stock has fallen so much due to China growth. It's not because of China growth data, because of the property, people view back the property crisis again. So that's why it's what. Okay, wait for my coming YouTube video on this coming Wednesday. We're going to cover on that. Okay, so wait for that. Okay. CK Infrastructure earnings on decline with low ROIC. What's your thought? They are not a growth company. They are a dividend company that pays stable dividend. So you cannot view that way. Someone asked, what's your thoughts on Palantir? I got no thoughts on Palantir. I have not analyzed them yet, so I can't give you any insight. So do China Semicon. I've not analyzed in them, so I no insight on that. Philip asks, since like China is not doing well property, is it invest like Alibaba in the States than rather in Hang Seng? No, you invest in Hang Seng, invest in the what is the same one. They are the same Alibaba. There's no difference if you invest in, because if the Hong Kong one goes down, the US one also go down. The US one go down, the Hong Kong one also go down. Okay. Yeah. So I just got to answer another maybe 2 to 3 questions. Then I'll just go to call it a day. Right. Eric asks, are there any sort of indication for insider share sales for a certain company? What do you mean? I don't understand. That means what? Like, how do you look at when the insider sell the share? Like I told you, it's like he owns 30% of the company, then he sell like 20%, or then you must see big concern. Martin asks, what do you think about China bank stock price look attractive now? I think Chinese bank their price to book value always get cheaper and cheaper. Okay, but the thing I don't like is the regulator. Okay, which I also share a lot in this coming YouTube on Wednesday. Did I share? Oh, sorry, I share on the AK one. Okay, because you can go and watch the AK one. I got talk about Chinese banks also. I mean, if you want bot, you just make sure it's a small percentage. Then you diversify all the banks, because in China there's a lot of banks, right? And sometimes the regulator will force them to like support the property market. Eric said a lot of director sales for the past 6 months. Okay, like I mentioned, director selling in the US is a very common thing. It's a very common thing in the US. So please do not take too much indication unless it's a big stake of a personal one. Okay. Okay, Matthias asked, what about Disney? Any intention for 5th to buy into it? We are not looking at Disney at this moment. I don't think we have interest on them right now. Like we have a lot of other stocks to look at right now, especially the Hong Kong market is so cheap. Okay. Yeah, I'm just going to answer one last question by Sok Ming, then I'm just going to call it a day. So there were perspectives that Hong Kong will not go back to the past good time as they lost their financial hub status. Thus, using 10 years history for IV will be not accurate. Any view on that? Okay, so at the end of the day, I can tell you, right, you go back to 97, right? 97 financial crisis. The top 3 worst countries that happens in 97 is Thailand, Korea, and also Indonesia. Okay, they dropped more than 60 to 80% drop from peak to trough. But in the end, the next 20 years, the best performing companies best performing countries in terms of the index is these 3 from the bottom all the way to the peak. So at the end of the day, right, yes, you can say that, but at the end of the day, it's cheap you can buy, you go inside Hong Kong market, there's a lot of quality companies there. They are selling at the cheap price. Quality is not like no quality, it's quality companies selling at the cheap price. A lot of stocks are yielding between 8% to 9% or maybe 10%. Right? It's a stupid valuation. Right? If you can see past this, right, even you go to Asian financial crisis, Hong Kong was also whacked. They are down 60%. Eventually, they also up 300%. So at the end of the day, when we invest, right, we also have to be a bit optimistic. Right? Even they don't go back to the past, buying at such a cheap price, buying a good business, a bargain price, eventually they will come back one. Okay? Do you agree what I just said? If you agree, please type yes in the chat box and let me know. Okay? Okay, so that's basically my thoughts on it. Okay, so what time is now? Now it's about now it's exactly 3 p.m. So thank you for spending 2 hours of your time with me. I hope you guys learned something up to this point. If you learned something up to this point, do let me know. Right? And if you like this webinar and you like that in future we should have more of this webinar, also do let me know. Thank you so much, and thank you for spending 2 hours of your precious time on the weekend. Okay, and I hope to see you guys live. If ever we have a live alpha quadrant meetup, okay, if in person, okay, if you do see me, do say hello to me in person also. Thank you so much, and I hope you learn again, and I will see you again. Thank you. Bye bye.